Christian Mueller-Glissman at Goldman Sachs is hugely qualified to talk about the linkage of the dynamics of the market into your portfolios, retail and institutional, around the foundation back to 1926 of the 60-40 portfolio. Christian, thank you so much for joining and your work with the CFA Institute, of which I'm a member as well. How dead is the dead 60-40 portfolio?
Yeah, listen, it always is a bit aggressive to say that you have the death of kind of one of the most basic and well-known investment strategies. I think there's always going to be some benefit to be balanced, no? But I think you have a particularly poor kind of starting point for these type of portfolios from two perspectives, no? I mean, first of all, everything is expensive. We know that. And equities and bonds are expensive at the same time. That was actually the same a few years ago. And still, these portfolios continued performing really well. But what's new is how we are starting the cycle. No, the cycle is starting with more inflation and flatter yield curves. And that just means that what bonds can offer you in the portfolio is even more limited, both in terms of returns and with regards to risk reduction.
One of the other determinants here is diversification, which over my span I've seen, for example, 300 stocks down to Fidelity 50 or what Sequoia did years ago. Tell us about your view on the new diversification if bonds are so unattractive. Do I own Apple, Amazon, and 7 other stocks?
Listen, it's exactly a good point you make there. I think you need to look for older sources of diversification than just what equities and bonds can offer you. I actually think there's going to be much more potential for regional diversification. In the last 20, 30 years, all the academic evidence is showing that there's no benefit of having a global portfolio. If anything, the best thing was to have all your money just in the US equity market. But now that we introduce inflation risk, inflation volatility, policy uncertainty, which we haven't had in the last 20, 30 years, and possibly much more macro volatility, desynchronized cycles, what we could get is more diversification across the markets and also across styles, across sectors, and the leadership is much less narrow. So to some extent, you should not just be in the winners of the last cycle and run a really concentrated portfolio. You need to branch out a bit. You need to diversify. And obviously, the other key area, which we all know and has already done really well, which will be more important in the portfolio, is real assets. If it's commodities or other sources of kind of real cash flows, I think that will also feature more heavily in the coming cycle.
Is cash better than developed market bonds right now?
Listen, this is the most interesting discussion, in my opinion, which is new. I think we all know that equities look better than bonds in the long run on most models which you can come up with. But the more interesting discussion is really bonds versus cash. People are forgetting, but bonds have for very prolonged periods of time lost you money versus cash. Actually, the hit ratio of cash outperforming bonds over a 10-year rolling period is nearly 40%. So it's nearly 50-50 that you essentially do better with cash than with bonds based on the last 100 years. We obviously have been in the biggest bond bull market on record, so we kind of feel that's quite unusual. But if you look back in history, there were plenty periods. And one of the most important indicators of how bonds might do versus cash is the steepness of the yield curve. And the steepness of the yield curve is half of what we normally get after a recession, exactly to some of the comments we had earlier, because there's so little optimism about the duration and the longevity of the cycle and how much central banks can hike. That means you have less buffer and you have less return potential for bonds versus cash. So I think definitely cash looks better versus bonds in the coming cycle than what we've experienced in recent years.
How about inflation? Doesn't that sort of erode the idea because your buying power is steadily going away with no coupon?
Yeah, I mean, it's always like, do you want to lose money fast or slow? No, I think the big problem is with cash, you're losing money very slowly, whereas with bonds, you obviously have other drivers. And we all know that real yields have moved to incredibly low levels. And there's really weird relationship you currently have where inflation expectations go higher and higher and higher, but the real yields, they don't follow. And we know that might change. And then you have some losses in bonds.
Christian, one quick question. You can't have a Mueller-Glissman article without an Ibbotson chart. You trot out the Roger Ibbotson chart like clockwork here, the long-term log performance of the equity market. And the great unspoken fear is another 1970s, the dismal 70s, the Carter malaise, the flatness of equity return. What's the probability of that?
Listen, I think it's definitely higher post-COVID and post the crisis than before, because we obviously have now this new inflation uncertainty. And inflation is I always say it's a very autocorrelated animal. Once you set it loose, I think it does create more uncertainty. It has spillover effects. And I think as a result of that, the probability has gone up. We still would argue that like a 70 stagflation, don't forget there was 10% annualized inflation over a decade. I mean, that is quite aggressive. And you also have to consider at the time, like the type of macro backdrop, both with regards to demand, supply disruptions, which were related to OPEC embargo, Iranian revolution. There were things going on which seem much more extreme than what we're dealing with. I think stagflationary momentum is something we need to fear next week, not next week, next year, where I think we know that growth will come down, inflation might remain sticky, and we get a bit of monetary policy normalization and potentially a bit of a catch-up for monetary policy, and that can be a bit harmful for markets. But I think the 70s stagflation to us is still a pretty extreme event, which I would still put more into the tail risk bucket, not the base case.
Christian, that was a clinic. It's good to catch up, sir. Send our best to Peter Oppenheimer as well.